Today we have a great event. We wanted to finish off the presentations with a tax event in terms of investments and tax. And we have two great presentations from Empire Life. Joining us today is Ken Crosson from Empire Life, as well as Alex Papale. Alex Papale is the tax and estate planning specialist at Empire Life, and Alex is well-regarded tax estate planning specialist with a sought-after ability to analyze and articulate complex matters. As a lifelong learner, he completed his graduate studies in both tax law and business law. His background is business. Tax estate planning allows him to provide complete advice and comprehensive solutions to problems faced by Canadian residents and business owners. Alex has held various seminars for professionals to raise awareness of tax planning issues, challenges, and opportunities. He is also an active member of the Canadian Tax Foundation as a reviewer of the Quebec articles in the Canadian Tax Focus, a national publication in which he has published articles. Before joining Empire Life, Alex works for renowned accounting and legal firms, where he regularly advised clients on various tax and estate planning matters and participated in a number of reorganizations involving Canadian corporations. I know you're going to enjoy today's presentations, and without any further ado, I'm going to hand it over to Alex, and they can take it away.
All right, thank you, Don. Before I get started on today's presentation on taxation and investment income, I'll just pass the mic to my colleague Ken Crosson, who will talk quickly about what's new and what's been happening at Empire Life Investment lately.
Awesome. Thanks, Alex. Thanks, everyone, for joining us today. I'm Ken Crosson, an investment wholesaler here in the GTA area, and hopefully joining us as well as some of my colleagues from coast to coast, from east to west coast. So again, we appreciate the support from IDC. We've been great business partners over the years, and I wanted to touch on a few things. So I'm just going to go, Alex, if you go to the next slide. Looking at the agenda, let's look a little bit about the offerings that we have available on the segregated fund side, because it has been expanding. It has been expanded beyond value. Going to look at a few sales ideas on the gift contracts, what they call our sweet spots. And then also looking at another issue that as advisors, I know everyone is contending with, which is an income dilemma. With this low interest rate environment, how can people garner enough income to sustain themselves in retirement? So Alex. So we're known as a value shop. Going back, our elite equity fund that runs back over 50 years has had a great long-term reputation, and it still does as a value manager. And what we've seen, especially since 2017, the market was really focusing on some growthier areas, and value was out of favor. Going back to the days after the vaccine was announced back in the fall, we've seen a rotation back to value, and we've been rewarded again for adhering to our investment style and philosophy. Given days, there's been a lot of volatility recently. We see tech having a great day, and then value stocks having great days, and vice versa. But the trend has been in place, and so advisors who have partnered with us in that space have been definitely rewarded well. To complement our style, we have been adding more and more options available to you, the advisors, that you can take to your clients. One such example is the multi-strategy, where Dave Patterson joined us several years ago now to launch our multi-strategy funds. We're up to over 8 different offerings on this platform. And what's special about this adding in is that it's the first time where we've added some passive ETFs into the mixture of a portfolio, as well as some third-party active managers as well, where Dave outsources to some of the top money managers from around the globe. We also have some smart beta, where there's slants or tilts in the portfolio. So Dave monitors this on an ongoing basis. So from some pure equity ones to some balanced asset allocation ones as well, for conservative clients, for instance. In addition, we recently launched our Global Sustainable Equity Fund that falls under that ESG banner. But again, it's something that we've always done here at Empire as well, in terms of outsourcing when we're looking at businesses to good quality managers making sure that they have sustainable business practices in that environmental, the social, and the government sections of asset management. Some of the other things we definitely do beyond just running money is bringing you value in terms of advice, whether it's like a tax presentation that Alex is going to do today. Peter Wouters holds the TRIP seminars that people love coast to coast. More and more specific training programs for business building, for instance, as well as more portfolio management commentaries that we continue to offer. Next. Touch on a few sweet spots here on the portfolio. Specifically, with the aging demographics, we definitely have a lot of folks calling us up on a pretty regular basis looking for solutions for over 80, or how do we get our clients locked into some good benefits for the rest of their lives. So age 80 is a specific number here in terms of all of our accounts can have resets that occur up until their 80th birthday. And the nice part too is if anyone buys our 75-100 or our 100-100 contracts, they will have locked in that 100% death benefit on those deposits, plus any additional money they add into the contract until age 90. So you get an extra decade there of full 100% death benefits on new deposits. If somebody comes to us with new money after age 80, again, you can open up those same two contracts, but with a 75% death benefit. We have some other solutions I won't get into today, but where you can still have that owner own the policy and have some younger annuitants still purchase the 75-100 contracts. On the 75-75 contract, we are the only company out there that offers built in, no additional charge, an annual death benefit reset, just like our other products. On that, ideal for business owners, people who want to have a low-cost solution. I'll just use myself as an example. Back in 2018, I bought the 75-75 contract, and the following December 2019, I was already up to 91% death benefit because Empire sends me the slip in the mail showing here's your new death benefit. This past 2020, I'm now up to 96, almost 97% death benefit, and that's after 2 years. So simple math though, if you had a 5% gain over 6 years, that's going to give you 100% death benefit on your original investment. So 75-75 is definitely a great solution for younger clients who want to keep their fees and costs as low as possible and still get an annual death benefit reset. Take a look at preferred pricing. We offered this now on our GIF Segregated Fund platform. And the nice part on this is you can get up to 25% basis points on deposits up to 500,000 and a full 50 basis points over $1 million. And I'm going to give a little example on that in a second. I have DSC low load, no load, and FE there. The reason why I'm showing you that is with our higher net worth pricing, it doesn't get restricted to just one sort of purchase. However you want to run your business, whether it's DSC or low load or no load, the no load with the charge back to you, you will still, those clients who buy that will still qualify for our preferred pricing. And lastly, I'll take a quick look at the gift growth bonus. So on the gift pricing, this is a hypothetical couple here. Husband, he's got 450,000. Wife has 550,000. And so initially, she qualifies for the 25 basis point reduction on her assets because she's over the $500,000. And we will gather all owned accounts automatically that way. There is a householding form that you can fill out to link husband and wife. The reason why you got to fill out the form is for privacy reasons. And once they're grouped together, we combine both of their assets. So in this case, they're at the $1 million mark, and now both of those policies qualify for a full 50 basis point reduction in the management fee. And so I'll just skip to the preferred pricing one. So if you're looking at a moderate growth portfolio, which is 60 equity, 40 fixed income, or global moderate, or the multi-strategy global moderate, you're running at MERs of 2%, 2.06, et cetera. You can get even lower if you can combine some portfolios with fixed income to bring that into the 180, 190 mark as well. So it's a great solution. Other relatives, family members can also be combined to get that preferred pricing. So even if someone has a $5,000 TFSA, they will qualify as well. Next. For 2021, we have a GIF growth bonus, and this is referring to an extra commission that we're going to pay you, the advisor, come January 2022. So basically what we're doing is we're adding up all your purchases into the GIF segregated funds, and that's the first part of the program. So in this example, person does 3.1 million in sales. Go to the chart there, that's an extra 45 basis points of commission guaranteed. So even if that person redeems all that money, which we're obviously not advocating to do, you still hold on to that $13,950, those 45 basis points. The second factor of the bonus is the retention. So how much money stays with Empire. So in this example, we're showing that 92% of the money stayed on the books. That then gives a 145% gross up factor. So the commission bonus goes from $13,900 to over $20,000 directly to you, the advisor. And then again, the nice part about this is it is not shared with the MGA. It is paid directly to you, the advisor. So it's even more so than had it gone to the grid. Alex? Quick thing here on the income dilemma. Again, we're all well aware, record low interest rates is basically taking away the days where clients could, clip coupons on their bonds, get high GIC interest, and live off of that money. So they have to start looking at other alternatives. Fixed income bonds, again, are in a low interest rate environment. So people have to go up the risk spectrum a little bit to try to capture higher yield through dividends in corporate bonds, et cetera. So that brings us to some of the alternatives. Corporate bond fund's a great alternative. Short-term high income fund is another one. And last but not least, you look at our Class Plus. And we are the last remaining true GMWB guaranteed income for life product in the marketplace, where there's a guaranteed 4% bonus for every year during the accumulation years. You can go up to 80% equity to maximize the growth potential of the portfolio. We're doing resets there on a triennial basis to lock in a higher income base. And that continues even in the income years where people can maximize a higher cash flow in retirement. The annual payments go from 2.85 if somebody's 55, it's 4% at 65, and it goes up to 5.25. And it increases for each and every year the person maintains their investment in the Class Plus. RRIF Advantage, that's basically always saying it's the RRIF that will never run out, and we're always going to pay the higher of the RRIF minimum or the LWA, guaranteed lifetime withdrawal amount. Alex. So summary, Empire, one-shop go-to place now in terms of a diversified asset lineup from our traditional value approach to multi-strategy, to more growth-oriented portfolios as well. Got some sweet spots in the investment lineup on the segregated fund front, as well as the class fund front. And again, go see I recommend you to go see your local investment wholesaler. Great team right across the country, and we're all here to help you definitely grow your business. Next. Quick chart here, again, just showing how well the funds are doing. Asset allocation is one of the top 10 largest funds in the country. First quartile across all categories, 1 to 10 years, everything in between. Elite balance, elite equity, again, all solid funds that we'd be happy to dig deeper and talk to you further with going forward. Next. And then next slide, again, see feedback while the presentation is going on. And I know you're watching Alex, but if you did want to shoot me any messages, feel free to use the chat. I'll be happy to answer back as well and go from there. And at this point, I'll turn it over to Alex. And again, thank you for your time, all your attention. Thanks for tuning in on a Thursday. I don't know what rest of the country, but Southern Ontario, we're pushing 80 degrees with the Humidex. So it's, again, thanks for your participation. Thanks, Alex.
All right. Well, thank you, Ken. Nice weather in Quebec also. So I heard people in the West in Calgary are suffering a bit in terms of weather today, but Lucky to be in nice weather in the east. So now the impact of taxation on investment. We've been I've been asked to talk about this topic because there are issues like choosing the right fund, positioning the fund properly, using the income sources efficiently. It's issues that clients and advisors have to deal with regularly. And when addressing these issues, questions that often come up can include: what are the tax consequences of choosing a certain option? Is there a negative tax impact? Is there a way to reduce taxes that my spouse and I will have to pay? What could we do differently to improve our situation at retirement? So one of the objectives of today's presentation is to leave participants with a better understanding on how the positioning of assets can have an impact on the taxation of their clients' income, and especially at retirement. We'll also look at some simple, easy to understand, and easy to explain strategies that can be used when speaking with clients. So these strategies could have impacts on clients' retirement planning, and obviously thereby making the advisor who suggested them a trusted resource. So we'll start by looking at the taxation of sec funds. More specifically, we'll see the tax consequences for individual investors holding different types of non-registered funds. We'll look at ways to optimize the tax efficiency of a client and then for a couple. And we'll look at all these different elements through a case study. So the case study is the following. We'll follow a couple who has invested in Empire Life Sec Funds. Sean is age 65. He's a conservative investor who owns Segregated Fund contract, which has 1,000 units of non-registered Empire Life Bond Fund Class A. Sean is married to Joan, who is also 65 years old. She's less conservative than Sean with her investing choices. She owns a Sec Fund contract, which has also 1,000 units, but of non-registered Empire Life Elite Equity Fund Class A. So they've received their allocations for the year 2020, and they would like some help to understand the tax implication of these allocations. So before we look at the actual allocation of Sean's Empire Life Bond Fund Class A, I just wanted to share with you the asset mix of the fund. We can see that it's composed of 91% of Canadian bonds, about 8% of US bonds, just under 1% of cash, and a little bit of international bonds and no Canadian equity. And that's on as of April 30th, 2021. Now, question that I ask you, considering that the asset composition that we see on the screen, what form of income allocation do we expect to see for Sean? Well, with that many Canadian bonds, we surely expect a significant amount of interest income and possibly a bit of capital gains if some bonds have been disposed of in 2020. Let's see if we're right. So the segregated fund income allocations are now available for years 2019 and 2020 on the advisor section of the Empire Life website for all our funds. It's presented on the website in a similar way as how it appears on the screen at the moment. Yeah, and the allocations are indicated per income form on a dollars per unit basis. Therefore, for advisors and clients who are considering investing in a certain fund, it's possible for them to know the allocations that have been made from that fund in recent years. Even though these allocations are not obviously a guarantee of the future, especially again, obviously for the amounts allocated, it may be an indication of what to expect for years to come. In our example, we can see that allocations from the bond fund Class A took many different forms in 2020. There are allocations of interest income, as we expected, but the interesting thing is in terms of proportion that there are about half of the capital gains, and this we did not expect. Allocations also include Canadian dividends and foreign income, which may be unexpected coming from a bond fund. So the question that I ask you is, why do we have all these forms of allocations? Well, part of the reason is the method that we use to pay for expenses at Empire Life. Our approach is to use the least tax efficient income to pay for expenses first, which may drive up the tax efficiency of the allocations. We'll look at the nature of income and tax efficiency in the next few minutes, but since interest income allocations are less tax efficient than capital gain allocations, it's possible to think that these forms of income have been used to pay for the fund expenses, which would explain in part the proportion of allocations that we see on the screen, and more specifically, the interest to capital gains. But let's look at the asset mix of the Empire Life Bond Fund and see if we can get some more answers there. So we can see that part of the asset mix includes investment grade corporate bonds, as well as provincial and federal government, which is not a surprise considering the name of the fund. However, we can also see there are preferred shares in the mix, which may explain why we saw allocations of Canadian dividends. If any of the assets have been sold with capital gains being realized, that would explain the capital gains allocations. Therefore, and what I wanted to get out of this is that it's important to look beyond just the name of the fund when trying to determine what form of income will be allocated to unit holders. The possibility to consult prior year's allocations of different funds can give an idea as to the form of allocations that could be expected in future years, assuming obviously that the asset mix is maintained in similar proportions. Now let's do the same exercise with Jones Empire Life Elite Equity Fund Class A. Again, before we look at the allocation, let's just take a look at the asset mix of the fund. We can see that it's composed of about 53% of Canadian equity, 31% of US equity, about 11% of international, 5% of cash, and just a little bit of Canadian bonds. So I ask you the same question here as I asked you before. Considering that asset composition, what form of income allocations do we expect to see for Joan? There will surely be some capital gains if assets, such as Canadian equity, US equity, international equity, have been disposed of in 2020. There would also likely be some Canadian dividend income, considering that almost 53% of the fund is composed of Canadian equity. There might also be some foreign income from dividends paid by US and international corporations. Let's see if we are right about this. Well, we can see that there were only capital gains allocations for unit holders of Elite Equity Fund Class A in 2020. Even though the fund is composed of Canadian, US, and international equity, no foreign income, no Canadian dividends have been allocated. Question is why? Well, the first possibility would be that the companies whose shares are held within the fund have not declared any dividends in 2020. This could be a realistic possibility, or more realistic than usual, considering that a lot of companies have reduced or stopped their dividends in 2020 to keep some cash available in the context of the COVID pandemic. However, if we go back to 2019 and we look at the allocations for 2019 for the same fund, the allocations were in capital gains only in 2019. Therefore, the answer probably lies in the method, again, in the method that we use to pay for expenses at Empire Life. As we saw earlier, our approach is to use the least tax efficient income to pay for expenses first, which may drive up the tax efficiency of the allocations. Again, we'll look at the nature of income and tax efficiency in the next few minutes, but since foreign income and Canadian dividends allocations are less tax efficient than capital gain allocation, it's possible to think that these forms of income have been used to pay for the fund expenses, which would explain why they are not allocated to unit holders. Before we look at ways to optimize the tax efficiency for Joan and Sean, we'll just look quickly at what their allocation mean in terms of taxation. So as we saw earlier, Sean was allocated just over $342 of interest income. Since interest income in Canada is fully taxable, Sean has to include the whole $342.41 of interest income in his income calculation for the 2020 tax year. The interest income will be taxed at Sean's marginal tax rate, which will depend on his taxable income. If we take the assumption that he has $100,000 in taxable income, the interest income allocated will be taxed at the combined. So when we talk about combined, it's federal and provincial. So the combined marginal tax rate of 43.41% in 2021 in Ontario. Sean was also allocated just under $60 in Canadian dividends. So and the taxation of Canadian dividends is a little trickier than interest income. Canadian eligible dividends. So eligible dividends are the dividends that are usually received from public Canadian corporations. They have a gross up and tax credit mechanism. So the amount of dividend is first grossed up for the purposes of net income calculations, and then federal and provincial tax credits are applied. So in 2021, the dividend gross up on eligible dividends is 38%. The federal dividend tax credit is 15%, while the provincial dividend tax credit is 10% in Ontario. For someone like Sean, who has a taxable income of $100,000, the combined marginal tax rate on eligible dividend income, so here we're talking about the combined, so federal and provincial, tax rate on eligible dividends. So that's after the gross up and the tax credit are applied. So this combined marginal tax rate on eligible dividend is 25.38%. Little offset here on the slide, but I'll just run you through it. For someone who would receive an eligible dividend of $100, there would be a dividend. So if we look at the left column here, there would be a gross up of 38%, and the amount of dividend that would be included in net income calculations would be $138. Federal and provincial tax credits would be applied afterward. For Sean, the amount of almost $60 that he was allocated in dividend income will have a dividend gross up of $22.66. And Sean will have to include $82.28 in his net income calculations for the year. Since it's the amount of just over $82 that will be included in Sean's net income calculation, it's that amount that may affect the level of Sean's government benefits and not the allocated $59.62. We'll discuss this a bit further a little later in the presentation. So again, from the amount of net income of $82 and a bit, from there the tax credits will be applied. Foreign income allocated to unit holders is fully taxable. So for Sean, this means that the whole amount of $127.45 has to be included in his income calculation for the 2020 tax year. Dividends from foreign corporations do not benefit from the dividend tax credit that we just looked at. Capital gains. Now in Canada in 2021, you probably know that 50% of the amount of capital gains are taxable. So when segregated funds investors are allocated capital gains, it's important to understand that it's the gross amount of capital gains and not the taxable portion of capital gains, which is being allocated. Therefore, so in the case of Sean, you would have to include 50% of the allocated amount of $727 of capital gains in his income calculation. Then the amount of $363.59 would be included in Sean's income and would be taxed at his marginal tax rate. So if we go back to our assumption that he has $100,000 in taxable income, the effective tax rate. So when we talk about effective tax rate for capital gains, we talk about the gross amount minus the inclusion rate and the taxation on that amount that's included. So it's the net of all this process. So the effective tax rate on the gross amount of capital gains allocated to Sean would be 21.7% in Ontario in 2021. The same principle applies to capital losses. So as I'm sure you're aware, segregated fund policyholders could be allocated capital losses. If that were to happen, 50% of the allocated capital loss would be included in the computation of the policyholder's income. But we'll look at how capital losses work in just a few minutes. The tax consequences for Joan are much simpler, simply because she was allocated only capital gains. So these capital gains will be taxable in the same way as we just saw for Sean. So in the case of Joan, she would have to include 50% of the amount of almost $13,000 of capital gains allocated in her income calculation. The amount of $6,423 included in Joan's income would be taxed at her marginal tax rate. So if Joan was taxed at the highest marginal tax rate for individuals, so that would mean that the effective tax rate, so effective, again, just to be clear, it's really coming from the gross amount, including 50% in income calculation and then having the applicable tax rate on that 50%. So the effective tax rate on the gross amount of capital gains allocated to her would be 26.76% in Ontario in 2021. Now, let's add some facts to the case scenario, make it a bit more interesting. So we'll add some hypothetical allocations for the for the year 2021. So, well, again, these allocations are hypothetical for illustrations purposes only, and obviously they are in no way a guarantee of allocations on units for the year 2021. So in these hypothetical allocations, both funds have allocated capital losses to their policyholders. So this is, again, as I was mentioning, one of the advantages of sec funds, and capital losses within the sec fund can be allocated to unit holders, and these unit holders can then claim the capital loss in their income tax return. Deductible capital losses can only be applied against taxable capital gains. Deductible capital loss can be carried back to any of the 3 preceding years, and we'll see in a few seconds how this could work. This means that it could be used to offset some capital gains realized in the previous years. Whatever is not used in the preceding 3 years, well, capital losses could be also carried forward indefinitely and used to offset future capital gains. So what I mean by carry forward indefinitely is that they do not expire if they're not used after 5 years, 10 years, 15 years. It doesn't matter, they still stay just outstanding until they are used. So for capital gains, capital losses, what we can kind of understand at this point is that the first step is to calculate the amount of taxable capital gains or deductible capital losses from the amount of capital gains or losses allocated by a sec fund. So as we saw earlier, Sean was allocated about $727 in capital gains in 2020, while Joan was allocated almost $13,000. Since the inclusion rate of capital gains was 50% in 2020, taxable capital gains was $363 and a bit for Sean and $6,423 and a bit for Joan. So the inclusion rate of capital losses is again 50% in 2021, which means that the deductible capital losses would be for Sean $113 and a bit, for John $11,423 and a bit. If the inclusion rate had been 75%, for example, in 2021, well, both Sean and Joan would have had more deductible capital losses than is shown on the screen. More specifically, Sean would have had about $170 in deductible capital loss, and Joan would have had $8,567 in deductible capital losses. So it's important to consider the inclusion rate at the time the capital losses were incurred to see how much deductible capital losses can be used, and that's what's important to remember here. Practical matters, what could be done by both of them? Well, Sean could carry back the deductible capital loss he realized in 2021 to his 2020 tax return to offset part of the taxable capital gains that he was allocated in 2020. If he does that, well, he will benefit from a refund of tax as a result of a reassessment of the prior year. Joan has realized more deductible capital losses in 21 than taxable capital gains in 2020. So what could she do? She could use part of the 2021 deductible capital losses to offset the taxable capital gains in 2020. The unused $5,000 in deductible capital losses could be carried forward for future tax years. If she realizes capital gains in the future, either from an allocation of her SEC fund or from another registered asset, she could use the unused deductible capital losses allocated in 2021 to offset those future capital gains. Now that we've seen what the allocations mean in terms of taxation for Joan and Sean, let's see how these allocations can impact the tax efficiency of their retirement plans and if there are any suggestions that we could make. So starting off with a little statistic. So according to a 2017 survey from Natixis Global Asset Management, only 22% of investors say that their advisor has focused on the tax implications by the type of investment income earned. Therefore, what does it mean for advisors? Well, it means that advisors who choose to discuss such matters with their clients will be part of a very small group. It's a great way to obviously differentiate themselves from competition while adding value to their clients. As I briefly mentioned earlier, the type of investment income earned can have, among other things, an impact on net income calculation. Well, for retirees, the net income calculation is important because it determines the level of certain government benefits and credits. And it also determines the amount of old age security clawbacks. Let's see how these things work. So taxpayers and net income can have an impact on government benefits and credits. So for instance, the net income can have an impact on an individual's age amount, which could increase the personal amount. So the personal amount we're familiar with, it's a non-refundable tax credit of $13,808 in 2021. This means that a client could earn income of $13,808 before paying taxes on it. If the client has an income of $38,500 and just a bit or less, in 2021, he or she could claim the full age amount of $7,637 in 2021. The age amount starts to be reduced over 38,500 of net income and is reduced to zero, so reduced completely when net income reaches about $89,000. Client's net income can also have an impact on the client's old age security benefits, as I mentioned just a second ago. So if the client's net income exceeds the threshold amount, which is this threshold amount is $75,845, so around $80,000 for 2021, he or she could have to repay part of their old age security pension. Part of their entire OAS pension is reduced as a monthly recovery tax. The repayment calculation for a client is based on the difference between the client's income and the threshold amount for the year. So the first step is to figure out how much higher the client's income is than the threshold, and then the client must repay 50% of that amount, of that difference. Some options to stay out of the clawback zone could include splitting income, but we'll look at this in just a few minutes. So I thought it would be relevant at this point to see what the impact of different forms of income have on calculation of net income. So the amounts received, and adding one that we haven't seen at this point, the amount received by clients from CPP, QPP, they count as income and they are fully taxable. So also, as you may know, taxes aren't automatically deducted from CPP and QPP. However, if clients can ask that federal income be deducted from their monthly payments by sending it to their My Service Canada account, or they may request for income tax deduction for a pension under the QPP to be made, and they can go on the Retraite Québec website to do that. You can see from this table that some sources of income obviously have a bigger impact, as we've seen earlier, than others on net income calculation, and therefore they have a bigger impact on government benefits and credits that we just saw. One source of income is missing on the table. Some of you might have picked up on that. We'll look at what it is. Well, it is this other income source is withdrawals from registered or locked-in plans such as Rrsps, RIF, LIFs. These withdrawals are fully taxable for the owner of the plan, and the nature of income realized in the plan does not affect the taxation of withdrawal. So no matter what form of, if it was sec funds held in the RSP, for instance, the nature, the form of allocations in the RSP will not impact the taxation of the withdrawals. So for clients with registered and non-registered assets, an idea, it may be a good idea to use registered plans for sec funds with a history of less tax-efficient allocations. As we just saw, the nature of allocations made in the registered plan has no impact on the taxation of withdrawals from the plan. Therefore, positioning sec funds of a client that have a history of allocations, which include interest and foreign income, and for retirees, Canadian dividends in a registered plan, while using non-registered money to purchase sec funds with a history of tax-efficient allocations, such as capital gains, like we saw earlier, could be a way to optimize the efficiency of income generation and positioning of the funds. Generating dividend income for a client may have different consequences, whether the client is a retiree or not. As we saw earlier, clients who are during their working years may find that the net tax rate applicable to eligible dividends is interesting. However, the grossed up dividend amount may have a negative impact on government benefits and credits as clients age. Advisors should be aware of this distinction when recommending dividend generation to clients. For instance, returns in the form of dividend realized in a registered plan would not be taxable in the plan, but they would be fully taxable when withdrawn from the registered plan, thereby at least avoiding the gross up in net income calculation that would have occurred if the same dividend income had been realized in non-registered assets. Another thing to mention regarding registered plan is the possibility to access the pension income amount. So this pension income amount is a credit of $2,000, which clients may be able to claim if they report eligible pension payments on their tax returns. Clients over 65 have an easier access to the pension income amount since, well, for those clients, so for clients over 65, periodic receipts from a RRSP or a LIF are considered to be eligible income for purposes of the pension income amount. So encouraging clients to contribute to their Rrsps and suggesting that withdrawals be done in the form of periodic receipts from a RRIF rather than a lump sum withdrawal from an RRSP are means that advisors can take to optimize tax efficiency for their clients over 65. Since the pension income amount is added to the personal amount of $13,808 and to the age amount, which could be up to $7,637. A good positioning of asset means that a client over age 65 could receive income of up to $23,445 before it becomes taxable. So quick statistics on TFSA, 68% of Canadians say that they have a tax-free savings account. Canadians are holding on average just about $31,000 in their TFSAs, despite the fact that the total room available in 2021 for someone who has never contributed and has been eligible for the TFSA since its introduction in 2009 would be $75,500. The contribution room is not based on income. And obviously, for a couple, we just multiply by 2, so it means $151,000 for a couple. And obviously, here we're talking about only contribution room, and the amount in the TFSA could be higher if there's accumulation due to investment growth. So we can see here that there's some room to grow, no pun intended. So when discussing tax optimization with clients, tax-free savings account should be definitely included in the conversation. Not only will the amounts deposited in the TFSA generate tax-free returns, but withdrawals from the TFSA are not included in net income calculations. Since amounts are not included in net income calculations, they do not impact the government benefits and credits that we saw earlier. And it also means that clients need less funds to generate one after-tax dollar, especially if the funds would otherwise be taxed at a high marginal tax rate. Taxation at a high marginal tax rate could be true if a client has a need in a particular year for a higher amount of after-tax dollars during that particular tax year to pay, for instance, for medical expenses or to make renovations on their home. So in cases like that. The last thing about TFSA is that they're flexible because withdrawals increase contribution room the following year, and therefore withdrawals could be recontributed in the future. Now, for clients that have spouse or a common law partner, optimizing tax efficiency should mean more than optimizing the tax efficiency of the client. It should mean really optimizing tax efficiency of the couple. So one of the ways to do that is to take advantage of the opportunities provided by the Income Tax Act to split income between partners. So splitting income allows for income to be taxed in the hands of the partner with the lower tax rate rather than in the hands of the partner with the higher tax rate. One form of income splitting is the possibility to split up to half of a client's eligible pension income in with that client's spouse or common law partner. So any pension income, well, that qualifies for the $2,000 pension income amount that we just saw should qualify to the split. So as we saw earlier, for clients age 65 and over, it includes withdrawals from registered retirement income fund or from a LIF. So Withdrawals from a RSP in the lump sum cannot be split since they're not considered to be eligible pension income for these purposes at least. So the possibility to take advantage of pension income splitting may be useful if there's an age difference between the two partners in a couple, and if the couple does not need a withdrawal from their registered money to live comfortably. We could think, for instance, of a situation where gentleman is 72 years old, while his spouse is 66 years old, sorry. And the spouse does not want to convert his or her RSP in a RIF right now. So the gentleman who recently had to convert his RSP into a RIF could transfer part of the payments from the RIF to his or her spouse, so that the spouse could benefit from the $2,000 pension income amount because the spouse is over 65. An advantage of splitting pension income is the one that I already mentioned, which is that taxes would be saved globally by having the transfer pension income tax at a lower tax rate. The second advantage is that if the receiving spouse does not otherwise have eligible pension income, he or she could use the $2,000 pension income amount against the transferred pension income. So coming back to the example that I just gave. To split pension income, a joint election has to be made. It has to be made on Form T1032, and it has to be filed in the income tax returns. And the election also has to be made annually. Another possibility to split income is by setting up a spousal RSP. So I'm sure people are familiar with that, but with such plan, the client makes contribution to an RSP of which his or her spouse or common law partner is the annuitant. What that means is that it's the partner who makes the investment decision, and it's the only one allowed to withdraw money. So the client's RSP contribution limit is the same whether he or she has one account or two accounts, and contributions can be made until at the end of the year the partner turns 71. So again, could be interesting if one spouse is older than 71 and therefore cannot contribute to his or her RSP, but the other spouse is younger than 71. So this this strategy is particularly useful if a client thinks that he or she will have a higher income or have accumulated more retirement assets than the partner when retirement comes. One thing to consider, one thing to think about is that advisors should be aware of the 3-year attribution rule that applies to spousal RSPs. This attribution rule means that if the annuitant spouse withdraws funds from the spousal RSP within 3 years of a contribution, the contributing spouse will have to include some income in his or her income calculation. And what's the amount that needs to be included in the contributing spouse income? Well, it's the lesser of the amount of the withdrawal or the amount of the contributions that have been made in the past 3 years. So it's the lesser of, and then it's included in the contributing spouse's income. The last income splitting strategy that I wanted to look at today, it's a strategy which, unlike the other ones that we've seen, it works with non-registered assets. So the objective in this case is to shift future investment income from the spouse or common law partner in the higher tax bracket to the spouse in the lower tax bracket. So the spouse in the higher tax bracket lends money to the spouse in the lower tax bracket. This receiving spouse, receiving partner, takes the money from the loan and uses the money to invest in non-registered assets. If the funds were lent at the prescribed interest rate, which is in effect at the time the loan is originated, and that's important, at the time the loan is originated, the attribution rules will not apply, and the income from the non-registered assets will be taxable for the spouse in the lower tax bracket. So this strategy is really interesting right now because the prescribed interest rate, which is a rate that's set quarterly by the CRA, by the Canada Revenue Agency, is at 1% during Q2 2021. So what that means? Well, it means that if a prescribed interest loan, so prescribed interest, we know now it's 1%. So if a prescribed interest loan is originated today, the interest on the loan could be locked at 1% for an unlimited period of time without having the attribution rules applied to the situation. So the loan could be supported by, the loan would have to be supported by a properly drafted loan agreement, and the interest on the loan, they must be paid every year. They must be paid within 30 years of the end of the calendar year. If we just look at what this would look like in Jones and Sean's example, well, in their case, the objective would be to shift future investment income. Again, we're shifting future investment income that would otherwise be realized by John, who we saw was taxed at a higher tax rate, to Sean, who is taxed at a lower tax rate. So a loan agreement is drafted. With that loan agreement, John loans $500,000 in the example, obviously it could be a different amount, to Sean at an annual interest rate of 1%. They chose this interest rate because, as they've been told, it corresponds to the prescribed rate when the loan is originated, and that's what the moment that counts. Sean uses the $500,000 to invest in non-registered sec funds with Empire Life. And since the sum of $500,000 comes from a loan at prescribed interest rate, the attribution rules will not apply, and Sean will include the allocations from the sec funds in his income. So what we've done is shift the allocations that would otherwise have been taxable for Joan at a high marginal tax rate. We've shifted those future allocations to Sean, who is taxed at a lower tax rate. Now, what do we do with the interest? Well, the interest of $5,000, which represent 1% on the loan, the amount loan of $500,000. So the annual interest on the loan of $5,000 will be paid every year by Sean to Joan. These paid interests would probably be deductible for Sean and taxable for Joan. So optimizing tax efficiency of a client begins by having a good understanding of the different sources of income and their impact on net income calculation. So today, among other things, we saw the impact that allocations from sec funds may have on income calculations of a client. The impact on net income becomes particularly important in the case of retirees who may see an impact on their government benefits and credits. Also, the Income Tax Act offers many income splitting strategies for couples or for couples of retirees. These income splitting strategies are tools that can help optimize the tax efficiency of a couple, obviously, but an advisor who understands these strategies will be able to use them as a tool to optimize the tax efficiency of their clients. Well, they may also use these strategies as a business development tool by demonstrating to potential clients how those advisors distinguish themselves from the 78% that we saw of advisors who do not discuss tax implications with their clients. So thank you for having been with us today. If you have questions that come up in the next few days, obviously, because sometimes it takes a few hours to kind of assimilate the material. Once you have had time to look at the copy of the presentations that I think you'll be able to receive. Don't hesitate to reach out to your local account executive team, your local sales team. If they feel like they need to reach out to me, they will, but they are very good. So I'm sure they'll be able to answer a bunch of your questions.
So Alex.
Yeah.
I don't know if you can bring up the chat, but there's a few questions there if you wanted to take a look at some, or if I could read them off to you if you like.
Okay, got it. Sorry, I'm trying to, if not within a lower time.
Yeah, one, for instance, I was going to just reiterate that all those distributions that Alex showed you in the presentation are on our website. If you just go to the empire.ca, search function there, you just go allocations 2020, and because we'll have this year's, last 2019, et cetera. So you can just find the ones that are current for this past year, and then you can see the allocations for each and every gift segregated fund by series as well, because the series amounts do change.
So I see a question, and it looks to be as to how capital loss are used. So if there's a year of lower tax rate, but with expecting a year of higher tax rate in the future, and if I get the answer correctly, it's a question of timing of using capital losses, and it's a choice to use them. You can use part of them, you can use all of them, you can use none of them, and that's a good example of using capital losses in a smart way. So let's say someone lost their job, in that example in 2020, but they realize capital losses. Maybe they don't want offset the capital gains that would otherwise be taxed at a lower tax rate, and then keep the losses for maybe next year when they expect to sell their whole non-registered assets and to realize a bunch of capital gains, and maybe keeping the capital losses for that year. So maybe some strategy into the timing of using capital losses.
Alex, does Empire Life use a time-weighted taxation approach on non-registered funds?
Time-weighted approach on allocations? No, we don't. It's not time-weighted. So someone who purchased into the fund 5 days before allocation time and beginning of the month will receive the same allocation.
Alex, maybe you can expand on that though, because if you bought it, say in November or December, the allocations are monthly.
Yeah,
correct?
That's correct.
So,
the
so there is,
yeah. Okay, yeah.
So it's definitely an advantage over mutual funds, especially later in the year. So yeah, I'll let you explain that.
Yeah. No, it's a good point because allocations are monthly, it's not time weighted, but the effect, because the allocations are monthly, the impact of not having the time weighted approach is not as significant as it could be if there were annual allocation, and then someone who buys in on the day, let's say in November, and Ken's example, then gets the allocation for the whole year, and then that's very penalizing. But someone who buys in November gets the allocation for only the month of November, so it's a monthly allocation, but not time weighted.
One of the things that's come up too is in the mutual funds, there's a lot of regulations, know your client regulations. Do you think that there's going to be more in-depth analysis of the fund recommendations in the seg fund side of things as well moving forward?
Is it an investment, more kind of I don't know, Ken, if you
yeah, for sure. I mean, I know, like on the wholesaling front, I mean, our management team, we're all definitely discussing this with advisors all the time. I mean, I think the industry is definitely moving that way. Ontario government's implemented for mutual funds from June 2022. We are not part of that in the seg fund space, but definitely I think in terms of the compliance and the regulations, I mean, it's just a matter of time. So although it may not happen then when mutual funds do, it definitely is coming, right? And obviously the know your client, the know your product rules are becoming more and more in depth everywhere, for sure.
And are you seeing a higher percentage of deposits being made on a no load basis, or are you still seeing a lot of DSC business?
It's definitely been switching. Yeah, these even 5-6 years ago were 80-odd%. I ballparked that on the DSC basis. It's definitely dropped, the DSC, more low load. Like I know for us, we introduced the no load, which is a chargeback to you, the advisor. That's our fastest growing load for sure, because of the advisor, if the client decides to redeem in the first 3 years above those 10% free units, it's charged back to the advisor and not them. So it seems to be a growing trend, as well as front end as well. Front end 0 you charge 0 to 5, but we typically see 0 to maybe 2%.
All right. All right, fellas, listen, we're at 2:07. Our time is up, and I really appreciate your presentation today. I'm sure the audience enjoyed it. I want to say thank you for participating in our university series, and thank you to everybody else for participating for the last 10 days on our university series. And we'll see you again soon at the upcoming webinars. Thanks very much, and have a great day. Stay safe. Thanks a lot, fellas.
Thank you.
Thank
Thanks,
you.
everybody. All the best.